love the channel and find it useful in becoming a happy retiree. Subscribe today. What's the future look like? I can't tell you if the next week is going to be good or bad in markets. It's been just an amazing plod forward. You know, statistically, this has been a very interesting year for stocks because we haven't had any giant moves higher in any given day. So it's not like we've had a 500-point up day on the Dow. We haven't had any giant down days either. So we've gone a year in markets, and this is measured by the S&P 500 without a 3%. That's it. Percent correction. I mean, it's just been a very placid lake. And we've just slowly plodded higher, seemingly week after week after week after week. This week, Dow Jones Industrial Average up 2% for the week. S&P 500 just shy of 1%. S&P 500 for the year up 15% for the year. 10-year Treasury trades at just above 2.25, so just around 2.4% is what you can lend money to the U.S. government. And you get 2.4% per year for 10 years. That's the 10-year Treasury. So that's what's happening in this market. Standard & Poor's trading at if you look at multiples or what it's trading at relative to earnings, a 12-month earnings multiple of 18.7, depending on how you measure this. This is a 12-month forward earning multiple. 15. That's on the higher range or higher end of what we've seen over the last 15 years. For U.S. investors pulled about $36 billion out of U.S. stock and mutual funds in the third quarter. So that's what's happening as far as the United States markets. Good morning. Welcome to Money Matters. We're talking about the kind of the foundation of what drives economies, and that's what our population trends look like. That's the best predictor of the, quote, future that we can get. And it's a longer-term view. It's a 10 and 20 and 30-year view. We're looking at the various population studies, all compiled by the Ned Davis Research Group, that give us a real window over the next 3 decades. So a lot of these numbers are from today into the next 3 decades out to 2050, 2050, what economies are growing, what economies are shrinking, what does the age look like in these economies, and then, of course, how that drives economic growth and markets. That's what really matters to you. Hey, Wes, what does the demographics really mean for me? Well, it gives you cover. It gives me the conviction to continue to be an investor in certain economies. If I know that we have favorable demographic trends underlying for the next 5 years and 10 years in a particular economy, that's a really important thing to know and understand because it drives investment returns over time, or at least it's a big contributor to investment returns. Sure, there's lots of other things that happen. There's new technological advances. There's companies that eat other companies' lunch. There's politics, there's tax reform or the lack thereof, there's healthcare reform or the lack thereof. So there are all these, there's of course a tremendous amount of variables and factors, but if you look at the force of demographics, it's almost as though it's a tide or a sense, it's a gravitational force that either propels economies higher or drags economies lower. And that's why I want you to understand this, to help you be a better investor, make better or more informed decisions. And that's exactly what today's topic here is. Now, we talked about this topic of, we looked at population is slow, growth is slowing. We are aging as a globe from a population perspective. But herein lies the nuance of demographics I think is so important. And there's a lot of economic research from this, but this is an economic study, a research study by Bloom and Canning on the increasing growth rate of the working age population as a share of total population. That's so important. And this study shows that as the total population, as this population, the working age, you call the mature working age, so folks that are 35 to mid 50s, let's say, that piece of the population, as that share of the total population grows, by 1 percentage point, it increases per capita GDP by almost 1.5 percentage points. So it's a really important sliver of demographic information that you've got to understand here, that we're trying to uncover here, that really matters. So it's been proven that there's a very positive relationship between economic growth long-term and working age or mature working age population. And that's exciting. They rise together. So we actually want to see population grow of the working age. That's what really matters. So let's talk this through. So the mature working age population, why does that help the economy? Well, number one, as this portion of the economy grows, it's a resource base that is actually producing at a better and faster rate. It's a more productive rate. And just think of it, think about this in your own career. Are you, when you get better and more productive, was it from 35 to 40 that you really hit your stride, or 40 to 45? Or was it when you went from age 25 to age 28? Think about the leaps and bounds you make as you get to be pretty darn good at your given career, given industry. You really, those productivity gains come as you are more mature in your overall career. So there's a real tailwind when that piece of the population gets better and better. Another reason for that, why that population, or the mature working age population, really adds to economic growth, is the kids either move out or they get old enough to effectively allow you to become more productive. You get back to saving and investing. You can invest more in education, more in resources. You pay more taxes to your community. And all of this helps push economic growth. We've got only a few minutes left here, and I've got to get to this my ratio. I know we've been talking about demographics, fascinating topic throughout Money Matters today. And let's go back to, so we've already established, look, the population of the globe continues to grow. It continues to age, but that's not necessarily a bad thing if the right segment of the population is growing. And that's this very important study within demographics, the working age or mature working age population. Now, again, why does that matter? Well, if the mature working age population, so let's call it age 35, when technically this research technically calls you being mature, all the way up to about mid-50s. It says that those are your most productive years. That's when you have the most productivity ramp up, hitting effectively your productivity stride. And that, as you can imagine, does a lot for the economy. Kids may be out of the house or more independent. Now moms can go back to work. Moms can go get more educated if they've been at home with kids. And then that adds to economic growth because we've got new people coming back into the workforce. So the working age population and productivity, they rise hand in hand. You could also, simply put, we get better and more productive as we age between that two decade window, 35 to 55 or 35 to 54. And then evidently the wheels come off. I don't know why we supposedly stop at 54, but that demographically really helps. And so this is this clear, direct relationship between growth in the economy and the working age segment of the population. And, oh, by the way, stock market performance over the long run. So as the labor force continues to grow, this portion of it, so do equity markets in general. Remember, you hear that the U.S. labor force productivity is coming, or labor force participation is coming down. That's a percentage number. The actual aggregate number of workers in the workforce or labor force continues to grow in America. So let's get to this ratio of really productive workers. We think about this, we think of this in terms, we call it the my ratio, which is just mature to young ratio. And what percentage of the population is that? And is it rising or falling? Well, it's getting better here in the United States. That's the good news. When that group, the mature working age population, age 35 to 49 in this particular study, rises relative to the population of younger workers, defined by age 20 to 34, stock markets go up. Equity markets tend to outperform or rise. The my ratio has been almost perfect in helping helping to identify the secular or long-term bull and bear markets since the 1950s. Here's the good news. The My ratio bottomed in the United States in 2016, and it has started to get better and better and better, and it's set to rise all the way into the year 2040. So we have 20 years of this demographic tailwind in the United States. That's good news for stocks. It's not the same, though, around the world. So the United Kingdom, UK, My ratio is set to fall until 2019. So we have there's still headwinds there for a few more years. In Germany, the My ratio is continuing to fall until 2021. You look at a place like India, though, you've got this tremendous expansion of mature working population that rises all the way until 2050. That's good news. But a place like Japan, right now, the My ratio is decent. It's rising until 2022, and then it falls and falls and falls for over a decade. So there's a real disparity between these different economies and regions around the world. That's why demographics, which in my opinion really relates back to how does the population impact demand for everything that we consume and then what companies earn. That's what's so important. Thanks for listening to Money Matters today. A fun show, lots of great calls. We talked about demographics. If you want to find me and the Money Matters team, easy to do so. Go to my website, wesmoss.com, WESMOSS.com. There's a contact button. Those emails come straight to me. Hi, I'm Wes Moss, and thanks for taking a minute to hear about what's so different about my new book, You Can Retire Sooner Than You Think. So unlike other retirement books, this book will give you a step-by-step guide, whether you're in your 20s or 30s or 40s or 50s, to learn from what these successful and happy retirees did to get there. I hope you enjoy the book, but more importantly, I know that it'll help you retire sooner than you think.